Oil falls below $70 a barrel and stocks rise as traders assess Iran's retaliatory attack on a US base in Qatar for signs of de-escalation. US PMI data shows ongoing expansion in June, and another Fed governor backs a July rate cut. Singapore's inflation falls again. That's coming up in our 5 Things in 5 Minutes on Tuesday, June the 24th. Then in our deep dive interview, ANZ Head of Asia Research Khoon looks at how Singapore's economy has come through tariff-related uncertainty and how well placed it is to handle potentially higher oil prices if the Middle East conflict did worsen.
If we start to see a sustained move up in oil prices, say over towards $100 a barrel in Brent, then that will translate through into much larger potential energy-related price increases.
But first in 5 and 5 with ANZ. I'm Alex Tarrant in for Bernard Hickey. Oil fell over 5% to below $70 a barrel, while stocks rose as traders assessed a retaliatory attack by Iran on a US base in Qatar for signs the situation in the Middle East was de-escalating. Qatar said the attack was intercepted. Meanwhile, in economic news, US June PMI data showed steady activity, with the composite measure down only slightly at 52.8. ANZ head of G3 Economics, Brian Martin, says services output cooled while manufacturing rose.
The data still show the economy expanding, but at a slower pace. And that's consistent with what we're seeing in other readings on the economy, that demand is moderating in response to higher levels of uncertainty. The outlook for future business conditions was a little bit softer and new orders eased back. So both those would suggest caution in the short run about aggregate demand in the economy, particularly with relation to accumulation of inventories, with discretionary spending.
At 4 a.m. Sydney Melbourne time, the S&P 500 was trading up 0.7%. The 10-year US Treasury yield was down 6.5 basis points at 4.31%. Gold was up 0.35% at $3,398 an ounce, while West Texas Intermediate futures were trading down 5.82% at $69.54 a barrel. The US dollar index was down 0.26%. The Aussie was up 0.05% at 64.54 US cents, while the Kiwi was up 0.1% at 59.68 US cents. Number 2. A second US Fed governor, Michelle Bowman, has suggested a July rate cut is possible. Here's Brian again.
Those views on rates are very much predicated on inflation readings remaining soft. Our expectation is that the FOMC will resume rate cuts in September. We think that the impact of tariffs on inflation is going to be transitory. That has been very modest so far. But we do sympathise with Fed Chair Powell's view that patience is required because there are some insulating factors against tariffs in the short run, like the front-loading of imports in the first quarter of this year.
Number 3. Singapore's annual core inflation measure was up 0.6% in May, compared to April's 0.7%. ANZ Head of Asia Research Khoon says the process of falling inflation remains on track.
And there's still downside risks to inflation in the near term, given all the uncertainty around tariffs and the slowdown that we're expecting from the global economy. Plus, the strong Sing dollar is clearly exerting downward pressure on retail goods-related prices.
Number 4. China kept key loan prime lending rates unchanged on Friday, in line with expectations. ANZ senior economist Zhao Pengxing says Chinese growth remains steady at the moment, but that rate cuts are in the wings.
We see another 40 bips cut to 7-day reverse repo rate this year. Deflation in the economy is deepening. We have cut China CPI forecast this year to 0. Interest rate cut will be necessary to reflate the economy.
Number 5. Japan's June PMI showed its manufacturing sector returned to expansion, while services activity also grew at a 4-month high. Meanwhile, inflation data on Friday showed the headline CPI up 3.5% annually in May, down slightly from 3.6% in April. Here's ANZ FX analyst Felix Ryan.
When we look at services inflation, that's a very key focus there for the Bank of Japan. That lifted from 1.3 to 1.4% year over year. So that increase there, that's steady increase in underlying inflationary pressures more broadly, really does suggest that firms are passing on costs in terms of higher labour costs, higher rice costs as well onto consumers. The higher rice costs there impacting dining out costs, which is a key part of the services inflation gauge there. And of course, on the labour front, we have seen evidence of growing wage increases as well.
Felix Ryan there. Now in our deep dive interview, I spoke to ANZ Head of Asia Research Khoon about how Singapore's economy was managing through the tariff turmoil and how well it was set to handle a potentially higher oil price.
In terms of the tariff that the US has imposed on Singapore, Singapore has the lowest baseline tariff rate of 10%. So on the face of it, that shouldn't cause too much disruptions to Singapore's direct exports to the US. But because Singapore is a small open economy where global trade and global growth is important for the city-state's economic prospects, any broader slowdown in the global economy will have impact on growth in the economy. Now, so far, exports have remained very strong, but that's mainly a result of all the front-loading activity as companies take advantage of the 90-day tariff pause to get as much product to the US as possible. And that's been reflected in the strong export numbers, particularly for re-exports, which has increased something like 40% year on year. And a huge part of that re-exports is going to the US. So we know a lot of this is front-loading activity, which is temporary. So while it might boost economic activity in the current quarter, we know there's ultimately going to be payback, most likely in Q3, once we see those export numbers start to moderate. So on a broad growth basis, we're still hopeful that the Singapore economy can achieve 1.5% to 2% growth for 2025.
How well placed is monetary policy in Singapore to take the growth baton on, I guess, after that front-loading boost finishes?
Well, what is very unusual about Singapore's case is, unlike most other central banks, which use interest rates as their lever for monetary policy, and we have seen Asian central banks continuing to ease monetary policy by cutting rates, like we saw with the Central Bank of the Philippines last week. In Singapore's case, they use the exchange rate as their main tool of monetary policy. Now, ordinarily, when faced with severe negative outlook on growth, the Sing dollar should weaken. But in the current instance, we've actually seen the Singapore dollar trading at the strong side or the upper bound of their policy band. The Sing dollar is strong because it is benefiting from safe haven and diversification flows. And even throughout the last week or so, amidst the geopolitical tensions in the Middle East, which has seen the dollar strengthen, the Sing dollar weighted exchange rate actually continues to stay very close to the upper bound. So again, that shows Singapore continues to attract inflows. And as a result of that, it makes it difficult for the MAS to ease policy through the exchange rate because it's almost futile to ease policy when the currency is this strong. So I think in Singapore's case, any easing to help the economy will have to largely come from fiscal policy. And in this regard, this is where Singapore still has a lot of policy space. It's projected to run fiscal surpluses of around 0.8% of GDP. So there's plenty of scope for the government to provide support to the economy if needed.
How well placed is the Singapore economy to handle a spike in the oil price if that does eventuate?
Well, at this stage, given that inflation has been falling and is well below its long-term average, there is some space for monetary policy to accommodate any near-term increases in oil prices. In fact, we've already seen the local retail petrol price rise by about 3 cents a litre, or that's roughly around over 1% just in the past week. So that's not going to disturb the overall headline inflation rate too much. But if we start to see a sustained move up in oil prices, say over towards $100 a barrel in Brent, then that will translate through into much larger potential energy-related price increases. But again, thanks to the current low rate of inflation, there's ample room to absorb that.
Khoon go there. I'm Alex Tarrant in for Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, June the 24th. Catch you tomorrow with how US consumer confidence has been tracking.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.